David Kimball, literally, and I looked, it's funny, became CEO in 2016 of Prosper Marketplace. Number one, that's where obviously the company first took off and finally started to make it. But more importantly, that's when you joined the idea of a trade and joined at the time what was called the Marketplace Lenders Association. And Prosper has been a champion for AFC and for the work that we're doing and really being a supporter of the entire ecosystem. So David, thank you for agreeing to speak. We'd love to come on up here and have, together with AV Mallik, who I am happy to say happy to say this is his first appearance post leaving DFPI in California. So now in his private capacity at Morrison Foerster, thank you so much for being here.
Thank you, Phil. Thank you, Ian. Thank you, the entire AFC crew. This has been a wonderful day. We've gotten to learn so much from our speakers, policymakers, founders, and yes, you have to put up with some lawyers like me as well. A couple of quick words. I'm going to introduce myself and then turn it over to David. Yes, I'm Avi Mallik, former General Counsel of the California Department of Financial Protection and Innovation. Spent close to 3 wonderful years of that job, appointed by Governor Newsom, to really thread that needle of making sure consumers are protected while promoting innovation, making sure that we are at the forefront of competition, and making sure that everything's working in a manner that is the envy of the world. Prior to that, I was the Director of Fintech Policy for the House Financial Services Committee. Did that from 2019 to 2022, first as Senior Counsel and then Director of Fintech Policy, working on such matters as AI in the financial services, as well as on digital assets and other matters. But I'm so excited to introduce David. David and I both have come from California and Northern California. He has the nicer firehouse. If you ever go to Piedmont, California, it is a beautiful place. I'm in Berkeley, California. But David, please share a little bit about yourself and your background. And you are an OG, as we heard from Phil. You all were the founders of the predecessor of AFC. Is that right?
Yeah, thanks. And that's always how you want to introduce your city, is you have a great fire station. So just good to know about ours. Actually, first, just by way of empathy, if you haven't already, I just encourage you to stand up. It's been kind of a long time. I'm going to stand up right now just to encourage you to stand up. But it's been, as was indicated earlier, you ate lunch, it's a little warm, it's a little dark. Just stand up for a second. So David Kimball, I've been with Prosper now almost 10 years. I became the CEO in 2016 as I came in as the CFO. And usually the transition from CFO to CEO is not because things are going super smoothly. And so I came in when there was just kind of a lot of chaos. You can sit down now. I came in when there's a lot of chaos. Prosper has been around for 20 years. I've been there, like I said, almost 10 of those years. And before that, I was at USAA, which I actually think is a true OG when it comes to fintech. It was a bank at the time that had $50, $60 billion worth of assets, and it had 2 branches. So you had to do that with a mobile app. You had to do that with a phone. You could not do that based on locations. Prosper itself started off as a peer-to-peer lender, peer-to-peer lending marketplace. So you had personal loans and you have individuals who could invest directly in those loans. And since then, we have added institutional investors, credit cards, home equity loans, and home equity lines of credit.
Great, thank you, David. So let's double click a little bit about this journey. Prosper was one of the true pioneers of lending marketplace. As we said, close to 20 years, right, since it came together. And fintech wasn't really a term when you all were started. You were talking about digital, folks were thinking about digital access to banking services and financial services, but it was really more theoretical and not with as much widespread adoption, certainly as today. So tell me about some of the lessons about Prosper's evolution that you've been so closely part of, that evolution to build this company, as well as the industry, and how it may have changed in ways you couldn't have predicted.
Well, yeah, as I mentioned, when I came in, there was a lot of chaos at the time. We had seen, this was an industry that had taken off. It really was doing amazing things, lots and lots of volume. But when I came in at conferences like this, you would hear everybody say, we're here to disintermediate banks. Banks will go away. And I came in from a bank. And I didn't have exactly the same attitude or the same approach. I viewed the banks as actually having something that we didn't have, which was they had capital. And they had customers who were really loyal. And what we had was we had technology, and we had a drive to do things differently. And so I always thought that was going to be something that we would see as an advantage. I was thinking, if this were in San Francisco, I wouldn't have a coat on, I wouldn't have a button-up shirt, I'd have a hoodie. I brought the jeans and I brought the tennis shoes, so this is kind of like a Fintech, I don't know, mullet, because I've got the business on the top, but it's more of the tech on the bottom here. The point there, though, was you wanted to do things completely differently, and I think the expectation was that everybody who worked in a bank or who was a regulator was an idiot, and we could do things better. The reality was a lot of people who were doing that had never been in those areas and didn't know what they didn't know, and a lot of mistakes were made and continue to be made. I love the fact that we pushed the boundaries, but when I look at kind of where we are today versus then, you've got a couple of big fintechs who are now banks. That was certainly not something that was on the horizon then. If you indicated to anybody that you had a balance sheet, well, you're an idiot. Like, why would you have a balance sheet? This is balance sheet light. That's how you get the multiples. That's how you're going to be viewed as a tech company. The reality is it's kind of nice to have a balance sheet. You want to be tech forward, but it's nice to have the ability to bring in those individuals and actually make that customer a lifelong customer instead of a transactional customer.
Thank you for that. And yes, having come from California to Washington, D.C., you learn very quickly when the tie comes off, when the tie comes off, and if you're in SoCal, when to wear the shorts. And I'd like to think that the way that these things work well is when Silicon Valley, Wall Street, and Washington, D.C. understand each other's cultures and work in ways that, the communication, as we've heard throughout today, is key across these very strong ecosystems. So let's talk a little bit about the macro environment that you have operated in. This has been a very dynamic moment in sort of history of the globe here. You've let prosper through different economic environments, near zero interest rate environments, higher interest rate environments, sort of some uncertainty about where things are going. So just share with us your thoughts about, whether the macro environment forced you to pivot the business, how you built resilience, and how you were able to maintain confidence as a fintech in a dynamic, 2 or so decades.
Yeah, listen, I would say that the economy has actually had less to do with it. It's more idiosyncratic events that have been the bigger issue for us. So I mentioned the transition from CFO to CEO. Part of what was happening that year is we had fraud events within our industry. We had the business itself. So if you look at the marketplace lending area, up until that time, it was if you build it, investors will buy it. Like that was just kind of the play, and the key was grow as fast as you can. If you've ever been in a credit-related business, it is really difficult to grow without widening your credit, at least kind of in an extreme way. And that was happening. And so we had this fraud-related event. We also had credit beginning to get away from the industry in total. And so the reputation of this industry really took a hit. So at that time, when I came in, I would say like the quarter I came in, before that, we had $1 billion worth of originations. So our platform is one where the originations take place on the platform. WebBank at that point was our actual lender. And so on our platform, we had $1 billion of originations. We, in turn, connect with investors. They buy those loans. $1 billion a quarter before, the quarter after, it was $300 million. Because the investors were like, wait a second, I want to pause on this. I don't think you guys have your act together. And instead of acting individually, they kind of acted as a pack. And so suddenly we didn't have anything there. So if you build a business that is looking to be able to originate $1 billion in a quarter and you suddenly drop to $300 million in a quarter, chances are your expenses far exceed what your revenue is at that given quarter. And so we had to make some pretty big adjustments. And so just before I came into the business, the company was doing so well, they anticipated that they were going to fill the earth with contact centers. We're going to have reps everywhere. What was really interesting is we're a tech company, but we thought that we needed exactly the same number of people per customer going forward. So we rented hundreds of thousands of dollars of commercial square footage. So we had some in Delaware, we had some in Phoenix, we had some in San Francisco, we had some in Utah. I was just going through our 2026 budget. We are still paying on some of that real estate in Utah. So we created not only these leases across the board, but it was leases for 10 to 11 years that we committed to. We have never used those spaces. We have sublet to a lot of other individuals or companies, but we never needed those spaces because the technology on the contact center side has moved along and improved considerably. So when I look at what we had to do, The one thing that I was super grateful for in 2016 is thank goodness there wasn't a recession on top of everything else that was going on. Because I think if there'd been a recession, it would have been difficult for us to continue as a company. So we made massive cuts at that point. We went from, at the time, 670 employees down to 350 employees by the end of the year. So it was brutal. But then prospectively, what we ended up doing is we looked at third-party contact centers. We looked at focusing on reducing fixed costs, all the things that you would do at any kind of established company. And when you look at our company now, we haven't raised capital since 2017. We've been able to, we haven't actually had a layoff since that 2016 moment. So in the middle of COVID, in the middle of some of the other issues that we've seen in the economy, we have adjusted our third-party labor, but we've maintained our labor as we do that. So I think that's the biggest one is, it's tough to move from go, go, go to no, we've got to be responsible and we've got to take this as a long-term. We want to be self-sustaining. That's really where we pushed into.
Great, thank you for that. Now let's turn from talking about the environment involving, the economy and building the company to the regulatory environment. We just heard from state regulators as the prior panel, including our home state Senator Tim Grayson. We heard from members of Congress, certainly including folks that are on the House Financial Services Committee. We are going to hear from acting FDIC Chair Travis Hill later today to talk about where their FDIC's vision of fintech oversight and regulation. So you've seen it all again in these 2 decades as the industry has grown, as certain product offerings have gone mainstream, as people have started using their phones to do sort of borrowing services, banking services in a way that we couldn't have fathomed even 10 years ago. Where do you think regulation is sort of headed? How do you sort of calibrate as a CEO and being a good steward for your business and your employees? Any thoughts about sort of where we stand in a moment of time today? And don't worry that a former regulator is sitting next to you.
Not a concern. So I will tell you that having been at these for the last 9 or 10 years, I wish the voices that we've heard today would have been the voices that we heard, say, 10 years ago. It is much more open than it has been. So thanks for that. I would love for that message to get to all of your workers in your regulatory agencies, because we don't always get that same position from everybody. It's mostly like drop down, this is what I need to do, this is what you need from me. And it is really difficult dealing with 50 different states. And then for us, when we started peer-to-peer, it was the ability for individuals to directly invest in individual loans. And when it was kind of GoFundMe with an expectation that you pay somebody back. And the SEC came to us, and this is before my time, but said, we really think that what you're issuing is a security. And our founder, very, very bright and definitely a purist, said, no, this isn't a security. We're going to fight on this. So we're an SEC registrant right now, and it took us a couple of years to get through that. Ultimately, I think that's been good for the consumer and it's been good for a company. It gives for us a really good discipline that not necessarily everybody has to face. I hate the fact that we disclose everything, because all of my competitors get to look down on everything that we've done, and there are a number of my competitors that I know nothing about what they do. But it's been great discipline for us. So I think actually having the regulators has been overall good. I think what is ideal is for that to continue to transition so that there's more of an open-mindedness to it. I think having, on the fintech side, people realize that there are regulations that we have to deal with. I think pressing on things and challenging the thought process is really good. Back in the day, I was doing securitization for autos. And so for those auto loans, we were one of the first issuers that did a securitization with electronic chattel paper. So just kind of put that in your head. Like, everything up until that point, you had to have physical documents, and we went through the ringer trying to establish the fact that even though it is digital, it is still, you can look through this and have title to the vehicle. That was difficult for the regulator to get their head around, because they're not motivated to take risks. And I'm not trying to bash regulators, but if you look at the incentive profile, we don't want anybody to blow up our consumers. We don't want to have a company blow up on our watch. And so there's a disincentive to take risk. If you look at the tech side, their incentive is to take risks. And you're going to get a lot of altruistic fintech CEOs and founders, and they're going to say, we're doing this because I have a huge heart and it's amazing and we're going to change the world. Their investors are like, change the world, but I need some money from this. And so there are differing incentives that take place there. And so that is really kind of where that difficulty is. I think it's gotten better and better, but the reality is you're coming from two different places. I think that's good to have that kind of tension there, but at any given time it can go too far one way or the other. And once you go too far, it's going to swing back really, really hard when something blows up on one side or the other.
Thank you for that. And this sort of dovetails nicely with what we heard in the prior panel. I think it was State Senator Grayson again who was saying he didn't view innovation to be in the opposite side of, let's say, consumer protection or protecting the public. So, and I will certainly say, as former director of Fintech policy in Congress and then former general counsel at DFPI, our philosophy was very similar in that if you have the right sets of rules in place, you have a more sustainable, lowercase s sort of industry that really allows for innovation to prosper, and we are sort of the engine of that dynamic growth. So turning to you as a CEO and as a leader, sort of how do you balance that need to promote innovation while also making sure that it's not, there's never like a house of cards or there's a thing that could hurt a lot of your users?
I mentioned the electronic chattel paper just as an example of we want to be forward-thinking. We want to make this easier and easier. I was at USAA when we introduced remote deposit capture. So this would have been kind of 06, 07, 08 timeframe. And it was something that we thought would be amazing for the consumer. Again, here you had this massive bank where they didn't have branches. So you needed to have some way for people to be able to deposit funds. And what was happening is they were sending in checks all the time. We just got massive amounts of mail, and it would take a massive amount of time. So the flip side of that, though, is we think that this is great, and it's ubiquitous now. All of you have this. It's embedded within your mobile apps now. But at the time, we were trying to figure out what was going to happen on the fraud side of things. So we still were regulated. We needed to make sure that we were covering things there. In hindsight, I actually love it so much more. Dealing with a physical check where you've got really personal information on it and that's going through the mail. Sometimes you're going to write your driver's license. Somebody was saying earlier you put your social security number on it. Insane. It is so nice to have that go through an encrypted transmission to an institution. The flip side of that is we have not seen, at least demonstrably, the massive fraud that we were all worrying was going to happen. I think you see more of that with the physical than you do with the digital. So as we look at overall where we want to go, ultimately, it's got to be for the consumer's benefit. It's got to be ultimately business sound as well. And I think that as we look at the ability for us to have even stablecoin, part of that is addressing the fact that it's so painful to transmit money across borders or within even the US. We've found a solution that makes that go much, much faster. The question is, do we have enough of the other rails around it to make sure that we're able to protect the consumer? That, to me, is the bigger concern. I think we're going to approach it with the right value system. I do have concerns about others who won't necessarily have those kind of self-governing values. What happens with them and how far do they go? And does that blow things up and just kind of knock things back so that you don't get as far as you need to? You kind of take one step forward and maybe a half a step back. I would love us to continue to go, but do it at a reasonable level so that we don't ultimately harm the consumer or candidly harm the space as well.
Thank you for that. And any of us, well, those of you who run a marathon, you don't want to be maxing out and sprinting those, first mile or so. This is a long journey.
I have no idea what you're talking about. I would never.
You look like a runner, though, David.
Not even kind of.
Well, now this is the part of the conversation where I'm contractually obligated to say the words artificial intelligence as part of any conference. So we're going to talk a little bit about AI and how your industry, your company are looking at this incredible transformative technology in the development. So everyone's excited, also nervous about the potential, this incredible potential of how AI can be embedded in the financial services industry. It could go from automated underwriting, could go from generative AI that is being used to engage with consumers and chatbots. It could be so many other things. And it certainly is reshaping credit underwriting and customer engagement. So question for you, when you see this and you see the promise of AI to transform the industry and your fintech products and services, What do you see that's good and you really want to double click on it? But also on the flip side, what are the biggest risks that we should all be thinking about right now?
Well, so what I would say is we've been using machine learning, an element of AI, since 2015 in our underwriting models. So we don't have humans making any decision. We haven't had that happen since 2015, and I can't respond to what was before that because I wasn't there. But that has been the basis for what we do. And what I would tell you is you can't, and I think this has been said many times today, you can't just kind of leave it to a machine. You have to understand what's in there. The humans are the ones who are providing information. I think one of the references was, there are a lot of racist things that have happened within the home lending. You can't just send AI just to absorb everything and just use that to underwrite. So we know that we've got these models. They are very powerful. They're able to do these calculations to get to segments that we wouldn't normally be able to get to. At the same time, there's got to be a credit strategy that goes with this. And so about a few months into the pandemic, I got a call from one of the big accounting firms, and they were doing a survey on fintechs, and they were asking, what's the secret to your success on the credit behavior in the consumer? And maybe this is 21. So you had a chance to see what was happening with the pandemic. And if you recall, if you end up having a 15% unemployment rate all of a sudden, chances are, all other things being equal, credit losses would go bizarre. Like it would just be terrible, and you'd see massive charge-offs. And so she asked me, what's the secret to Prosper's success there? And I said, well, government stimulus. Like everybody got checks, and they were able to use those checks to pay us back. And she stopped me, and she goes, so you're the 6th person I've interviewed, and you're the first person who has indicated that it's anything other than your AI model. So there are two things wrong with that. The first is, why were we 6th? Why weren't we like the 2nd person that she talked to? The second, though, is clearly that doesn't make any sense. I hope that the companies were in PR mode and they really didn't believe that. I will tell you, for our underwriting models, we exclude 20 and 21 from our underwriting models because we don't think it's a good representation. So we have actually had an underwriting model that's had really old data until literally yesterday, where we included 22 and 23 and 24 and beyond. We think those cohorts are so misrepresenting the way consumers really behave that it doesn't make sense to be in our data set. So AI is phenomenal. AI allows you to do things in a very different way, but it can't be brainless. You actually got to think about what you're putting in, and I think that's what the difference is, and I think it's a differentiator for us. We don't believe that it's all us. That would be just silly. I think we've got to make sure that we're guarding the tools as we go through.
Got it, thank you. To wrap this up to the sort of top of the conversation, and as Phil was introducing us, I joined Morrison Foerster actually just last month, and it is a wonderful multinational law firm, full services, working on everything from AI to financial services, and it's an incredibly dynamic moment in time. We like to think, as part of our team, that we're really in the first inning of this game, and we don't know where it's going to go. We don't know who's going to be the Ohtani who's going to be pitching and hitting it out of the park. But where do you see, sort of putting on your hat as a futurist, thinking about the fact that you've done sort of these 10 to 20 years, when we are sitting down like this in 2035 or something like that, looking back at the innovation and in the financial services and this era of fintechs, what do you think you're going to have seen these last 10 years? Where did we hit it out of the park? Where did we sort of step into a double play? Are you a baseball fan? Because I'm going to keep going
Not at all,
with this.
but I get it. I'm following you. I'm with
so
you.
where are we going to be looking back 10 years from now in this era?
Number one, I'll be retired. Number two, what I would say, a few months ago, I was at a conference of community bankers. And I've been at this conference probably 8 or 9 times. And every single time they bring out all the fintechs and they say, hey, community bankers, you need to be using these fintechs because you need to change your business. And so I asked somebody at one of the breaks, we hear this every year, why hasn't anybody changed? And he said, David, we're a small bank, and really what our customers really want is our honesty and our integrity. It's that personal relationship. I just want to be really clear, as I looked at the entire group there, it was mostly people who looked exactly like me. They were older than 50, they were white, they were bald. That is what's going to be different in the next 10 years, is you're going to have digitally native people come in, and those banks that every single one of them thinks it's our people, that is wrong. what is different is the experience is what makes the difference, and that experience is going to become more and more digital. So I do think fintechs and banks are going to come closer and closer together, and I think it's out of necessity for both. I think fintechs need the banks. I think the banks, certainly the big banks understand that they need the tech, but I think the community banks will get there even if people have to retire and die to get out of the way. It'll eventually get there. It has to get there.
Great. Well, thank you for your thoughts. I think we are at time. We see FDIC Chair Travis Hill there. Please join me in thanking David for his time.